Hello and welcome to the 2025 Gundersen Benefits video for open enrollment that takes place between October 28th and November 15th, 2024. My name is Michael Swartz. I am a certified financial planner and certified physician development coach. I'm also the co-facilitator of the Physician Retirement Readiness course, Honoring Onward, that I host with Dr. Chris Miller at Gundersen Health System. I'm also the founder of Health and Wellness. I've included a direct link to my email, my financial planning website, and my health and wellness coaching website in a link below this video. Gundersen has one of the most comprehensive and valuable benefits packages that I've seen. I've worked with physicians and medical professionals across the United States from New York to Hawaii, and I have never found a benefit package more robust or providing more value to the employee than Gundersen's. And so I will say it once more, Gundersen has one of the most valuable benefits packages that I have seen across the United States. With that, I'd like to make a note for the 2025 open enrollment period. Gundersen's 2025 open enrollment is an active enrollment. That means whether you are electing or waiving coverage, you do need to go into Workday and either elect or waive those coverages actively. This is not a passive enrollment in 2025. Finally, you only get one chance per year to complete open enrollment, and so it's extremely important to make sure that you make the right elections during open enrollment for the entire calendar year of 2025. So with that, please select wisely in Workday, and let's dive into the benefits. Looking at the 2025 benefits, we start at the top. We'll roll down through some of the general information, some of the more HR-related content of the topics, and then we'll actually jump into what's inside. And so our video will mirror the 2025 benefits guide that Gundersen has provided to you. We'll start with what's new and benefits basics, and then we'll jump right into the health insurance coverages. There'll be several updates that we'll cover in the what's new section, so I'll just table any discussion on the health insurance at the beginning. But then we'll jump into the dental coverage, any different savings or spending accounts. We'll talk through life, accident, and disability, disability specifically, whether that's short-term or long-term, and some of the elective coverage that they offer in the benefits package. Finally, we'll talk to some of the specifics of the 401k plan, and then we'll wrap up with some conclusions. As we mentioned, open enrollment will be from October 28th through November 15th of 2024 for the benefits period that begins January 1st of 2025. You've been told to review the open enrollment package, attend a benefits fair, and read some briefings in the bridge. You could also watch this video to get an overview of what the 2025 benefits will be, and then consider your coverage, have your information handy, log into Workday, and complete that enrollment. New this year, I am also offering a free 15-minute benefits review. So if you'd like to schedule a phone call with me, I'll also put a link to scheduling that phone call for your benefits below the video in case you want to call a certified financial planner and talk through what your elections look like, because most of these will be a case-by-case basis depending on your financial situation and family needs. All right, so what's changing in 2025? First and foremost, eligibility for retirees. If you retire or separate from service mid-month, you do not have coverage through the end of the month, through the entirety of the month. In the past, for retirees, we had actually recommended that they continue coverage through the month by retiring on the second, third, or fourth day to get virtually an entire month of subsidized health insurance without actually having to work the entire month. In 2025, all benefit plan coverage will stop at midnight on your final day of employment. That means if you retire on July 2nd, you do not get coverage through the final day of July. Instead, your coverage ends on the day that you retire or separate from service. This is a big planning note for retirees. Second, they offer domestic partners enrollment. And finally, eligibility will be required as proof for any new elections that you make or any addition of spouses or domestic partners in 2025 who are not currently enrolled in the health insurance or life insurance or elective coverages. The next big news is that Gundersen is going from offering 3 health insurance plans to offering 2. In the past, it was the HMO plan and the consumer involved medical plan, which switched to point of service in 2024, and then the high deductible healthcare plan. Those were your 3 options. It is going down to 2 now. And so it's either the Gundersen First plan or the high deductible healthcare plan. But of note, we are going from 3 options down to 2, and we can differentiate these 2 not only by the type of coverage that they offer and the structure of the plan itself, but by the savings plan that they offer. And so the Gundersen First plan will be known as the HRA plan, and the high deductible healthcare plan will be known as the Health Savings Account or HSA plan. And so we'll have a lot of conversation about these as we compare and contrast the coverages. Now, the health insurance reimbursement plan or the health reimbursement arrangement, the HRA, will be continuing to be funded by any carryover balances that you had in your cost share fund, but there will not be any new contributions to HRA. So only monies coming over from your cost share fund will be included in the HRA. And to use those HRA funds, you must be enrolled in that Gundersen First healthcare plan. So think Gundersen First, HRA, high deductible healthcare plan, HSA. Those HRA dollars will only cover 50% of those annual costs, and the collections and reimbursements are done through healthequity.com. Next, we look at the changes to the high deductible healthcare plan. These are nominal cost of living adjustments to both the deductible and the out-of-pocket for in-network and out-of-network coverage. For dental, there are new tiers. There are 4 premium tiers for dental insurance, including employee only, employee plus child, employee plus children, and spouse and domestic partner. Also, there are some nominal changes to the plans itself. We'll compare those dental plans when we get in there. And finally, for a health savings account, this HSA, the contribution limits have increased from 2024 to 2025. Again, nominal cost of living changes. And of note, you must be in the high deductible healthcare plan. So I'll say it once again, Gundersen First, HRA, high deductible healthcare plan, HSA. So what's changing in 2025 continued. You have an increased benefit options up to 2 times your salary with a max of $250,000 for employer-provided basic life insurance. In the past, it was $50,000 from employer life insurance with an election up to $250,000 employee paid. Now the benefit is employer paid up to that $250,000 mark. In addition, there are some changes to the spousal and domestic partner and dependent child life policies that we'll talk about briefly in that section. Next, employer benefits on short-term disability. They are 100% employer offered with weekly earnings up to $2,500. There was previously a 14-day elimination period. This is now a 7-day elimination period. So especially for expecting mothers, the short-term disability policy is going to continue your income for up to 90 days, up to $2,500 at a 60% replacement rate for your income. And for long-term disability, the long-term disability benefits will be provided through Unum rather than Lincoln Financial. And this benefit will be maxed at 60% of employer salary, up to $15,000 per month. Finally, some changes to the critical illness, hospital insurance, and accident insurance. Other than the provider and a couple of minor plan changes, not a lot of significant changes here. But finally, and most importantly, paid time off. So the cash out limits for PTO will actually decrease from 160 hours to 80 hours. This is a 50% cut in what you can get paid out at retirement or separation of service. And effective the first pay period in 2026, the PTO bank will be capped at 400 hours. So for those of you who have a large accumulation of paid time off, 2025 will be the year to use it. And knowing that there's a 90-day scheduling period for that paid time off for most providers, we really want to make sure that we're not forfeiting this paid time off that you've comped and banked, because that does not continue to roll over. It will be capped at 400 hours. Finally, there will be an automatic cash out for the balances over $480. Final day of that is January of 2025. So you will be able to cash out anything over 480 hours. You will be capped at a PTO bank of 400 hours. So you have to use at least 80 of those hours if you're carrying over that 480 hours in 2025. And you cannot cash out more than 160 hours on your final day of work. That will be brought down to 80. So Gundersen's basically telling you 2025 is going to be the year of PTO. Let's make sure you don't lose that benefit. So we'll scroll past the benefit basics and we'll jump into the medical coverage. And so as we noted, there are no longer 3 medical plans. There are only 2. So it's the Gundersen First HRA plan and the high deductible healthcare plan, which is the HSA plan. When we compare options, there's really only one thing to consider. What is the total cost to carry the coverage and what are my total anticipated medical costs in 2025? That's it. And so when we look at the Gundersen First plan, we're going to compare the pricing and the premiums to the high deductible healthcare plan to make that decision on which coverage is right for you. Here are the notes to make. To be on the Gundersen Healthcare First plan, we're going to compare employee plus family because this is the most straightforward comparison. Your monthly premium will be $324.47. Annualized, it's about $3,850 just to have the insurance coverage. So it's just under $4,000 to have your health insurance for the course of the year. That's very valuable to know because the employee plus family on the high deductible healthcare plan is only $70. Annualized, that's just under $1,000. So on day one, it's going to cost you $3,000 additional dollars to be on the Gundersen First plan. Why is that relevant? Because Gundersen is no longer making cost share fund or HRA contributions. So there's no way for Gundersen to give you additional dollars to be on the Gundersen First plan. But it is the only plan that keeps your HRA live. We'll jump into that detail in a minute. On the high deductible healthcare plan, however, it costs you just under $1,000 a year to be on this plan, or just under $850 to be more precise. And for the family plan, Gundersen will make a $1,000 HSA contribution on your behalf on January 1st or near the first of the month. That means that to carry an $850 health insurance plan that you are given a $1,000 HSA credit for, you actually start out $150 in profit or ahead to be on the high deductible healthcare plan. So under the Gundersen First plan, it's going to cost you $4,000 on January 1st to have your health insurance coverage. And to be on the high deductible healthcare plan for a family, you're actually going to be $150 ahead starting January 1st. Those are two very different numbers to start the year on your health insurance journey. So let's make sure we're very clear on that. The HRA and Gundersen First plan cost you $4,000 a year just to be on the insurance, and the high deductible healthcare plan actually makes you $150 in profit on January 1st. Next, let's jump down to the actual coverage of the plans and make sure that we're comparing these numbers exactly. So the Gundersen First plan now has a family deductible of $5,000 or an individual deductible of $2,500. That means if you or one of your family members has over $2,500 in medical bills, those $2,500 in medical bills will be 100% your responsibility. Now, half of those medical bills will be offset by your HRA balance, provided that you have one. So it's very important to log in to healthequity.com and check your HRA balance when you're evaluating this coverage for your health insurance. So on the annual deductible, an individual will meet their deductible at $2,500 of medical bills that come through, and half of those will be offset by the HRA. Or as a family, if two people meet their individual deductible of $2,500, the family deductible is maxed at $5,000. That means after you've met your deductible, you will have most likely 80% of coverage covered by your health insurance plan and 20% responsibility on remaining bills over the $2,500 individual deductible or $5,000 family deductible. And that remaining 20% will also be offset by the HRA balance. And so in total, if you have a lot of ongoing expected medical expenses in 2025, it may be beneficial to be on the Gundersen First plan. But once again, this is very much a case-by-case basis. That's why I'm offering this free phone call this year. Now, on the high deductible healthcare plan, the values aren't much different. It's only $900 more to meet the annual deductible on the individual plan and $1,800 for the family plan. And that health savings account that you're eligible for under the high deductible healthcare plan has some significant tax benefits. And so we'll compare and contrast these two in this conversation. The biggest piece I'd also like to point out, on top of the once you've met your deductible, 80% of those medical bills are covered, is that Gundersen funds your HSA on January 1st. So if you're on the family plan or individual plus children, Gundersen will credit $1,000 into your HSA, which is also on healthequity.com. The note here as well is that you are eligible to contribute up to $8,550 on this healthcare plan. And if you're over the age of 55, you can contribute an additional $1,000. The benefit here is mostly for high income earners. So what I'd like to point out is that any contributions made to your HSA besides the $1,000 that Gundersen puts in are fully federally and state tax deductible. And that's at your highest marginal tax rate. So if you pay taxes in the 24% tax bracket at a federal level and 5% state, every dollar that you contribute to your HSA will be an approximately 30% coupon on any healthcare expenses. And so when we max out the HSA, for those of you who do that, especially in higher tax brackets, there is a significant tax advantage to being on the high deductible healthcare plan. So again, if it's only on the health insurance plans alone, I welcome you to reach out to schedule that 15-minute call just to make sure that from a tax perspective and a coverage perspective, you're making the right election for your family. Next, we'll take a look at the dental coverage. And so, yes, there are 4 different tiers of elections: employee only, employee plus spouse, employee plus children, and employee plus family. But in general, there are only 2 specific dental plans. There's either the premium or basic dental. And there are only 2 differences between the plans. The most notable is the orthodontic services. So if you want to be on the enhanced or premium plan, you do get $2,000 worth of individual lifetime maximum coverage. And so for 1 year, if you have an individual who needs orthodontic services, it may be beneficial to get this plan. But it is generally not recommended that you get the enhanced plan unless you have these individual orthodontic services. In addition, there is a benefit to the enhanced plan for crowns, bridges, dentures, implants, repairs, and adjustments to bridges and dentures. So if there's a potential that you have bridges coming in 2025 or crowns, this plan offers a $2,000 annual maximum benefit as opposed to the $1,000 basic plan. So in choosing between the two, I would say this. The basic plan will be the right choice for most individuals who plan to get their cleanings done and any routine care. And if there's any advanced care, crowns, bridges, dentures, or orthodontic services, the enhanced plan will be the right option for you. Next, let's talk about those tax-favored health savings accounts, the HSA. The HSA is going to be able to be used for prescriptions, dental care, over-the-counter medications, orthodontics, and many other health-related expenses. The contribution limits in 2025 are going up slightly with cost of living. And so for a family with an HSA contributor who is under the age of 55, that contribution is $8,550. And with Gundersen making that $1,000 contribution for family plans, it's $7,550 to the individual. Now, this is particularly valuable because for high income earners, you get both the federal and state tax deduction and don't have to pay FICA taxes on HSA contributions. And for folks over the age of 55, there's an additional $1,000 catch up. So what this means is that 30% or thereabouts credit to any HSA contributions that will be met by a tax refund. Next, we're going to compare your 401k contributions to HSA contributions. Which is better? Well, when you're contributing to the 401k, you are still taxed on FICA earnings, whereas the HSAs are 100% tax deductible. That means there's an additional tax benefit to contributing to the HSA over the 401k. There will be tax-free earnings of both accounts, and any regular expenses will be taxed as ordinary income, but your 401k will have required minimum distributions later in retirement, whereas the HSA never has required minimum distributions. So there's a bit more tax benefit and a little bit more flexibility with HSA benefits. The other big note here is for those of you who are in your later working years and have a concern about long-term care, HSA credits can be used for long-term care costs. So this could be a very strong planning tool, once again, for getting self-funded for long-term care insurance rather than purchasing a policy. Making contributions to an HSA, investing those funds, growing those funds can be a very strong strategy for offsetting any potential long-term care costs in the future. Then we go on to comparing the FSA to the HSA. And so the FSA is a little bit different than the HRA. So under the Gundersen First Plan, it's the HRA plan, which any funds that came over from the cost share fund and went into the HRA last year will be carried forward into the HRA this year. You are also eligible to contribute to a flex spending account. So this is another tax-favored account that the employer owns, not the employee, but there's an annual contribution limit of only $3,200. And only $640 carries over in the FSA. So the FSA plan should be thought of as a use it or lose it plan. And we are only making contributions to the FSA that we know we will have expenses on in 2025. Additionally, remember that HRA is going to cover 50% of those costs. And so you only want to contribute up to 50% of your total healthcare costs into an FSA. Otherwise, you will forfeit them in 2025 at year end. That's a big note. The other big note here, making sure that we're not forfeiting HRA funds. And so I have an FAQ page for the HRA, which is different than the FSA. The HRA is that health reimbursement account that was covered and funded by the cost share fund. So in 2024, the cost share fund transitioned into the HRA. You can only use those HRA plans in 2024 when you're on the point of service plan. In 2025, that's the Gundersen First Plan. We have to submit all claims manually now. So that is through My Health Equity. It is no longer processed through the cost share fund processing team. You could find your HRA balance by either logging on to Health Equity or calling their number at 877-924-3967. If you've contributed to that FSA or HSA, you will need to create that new login and fund that FSA at open enrollment. So you have to elect how much you're putting into an FSA at open enrollment. The HSA can be contributed to anytime throughout the year. So the biggest note here is on HRA forfeiture. And many of my clients were not aware of this. One actually brought it to my attention with this FAQ page. So thank you. You know who you are. I appreciate your help with this. Is on an HRA forfeiture. If you're not enrolled in the point of service plan, the POS plan from 2024, which is now the Gundersen First plan in 2025, the HRA would have been frozen for up to 3 years and then would be forfeited. And so if that cost share fund dumped into an HRA and you don't use it for 3 years because you're taking advantage of the tax benefits on the health savings account and high deductible plan, you have the potential to forfeit your HRA. So as you're doing your benefits planning, make sure that you don't forfeit that HRA fund just because you're enrolled in that high deductible healthcare plan for 3 years. And being that we only have 2 options now, Gundersen First or HSA high deductible plan, if you elect that high deductible plan for 3 consecutive years, there is a chance that you will forfeit your HRA balance. And we do not want to do that, especially if it has tens of thousands or even hundreds of thousands of dollars in it that came over from the cost share fund. So be very aware of your HRA balance. So back to the benefits again. With the flex spending account, you have to make the contribution election during open enrollment, whereas the HSA can be contributed to anytime throughout the year. And the other big piece here is the employer owns the flex spending account, where you as the employee will own the HSA. Gundersen will make that $1,000 contribution. You can contribute up to $8,550, and there's that over age 55 catch-up provision. But to be on the HSA, you must be enrolled in the high deductible healthcare plan. So please, if you need any questions answered, reach out, because this can be complicated. We're talking about the Gundersen First plan with the HRA and the FSA versus the high deductible plan with the HSA. It could be very complex, but there is a very strong advantage to being in the high deductible healthcare plan if you're healthy. And there's a very strong advantage to being in the Gundersen First plan to use the FSA, the HRA, and not forfeit those dollars. So it really is a complex issue that requires individualized recommendations. Of note, all FSA, HRA, and HSA distributions will come out of health equity. So please make sure you know you log in there, and we can take full advantage of those benefits as well. Of note here, the Dependent Care FSA is a very valuable tool. It offers up to $5,000 per family each year to be passed through a Dependent Care FSA and then reimbursed to you tax-free for dependent care costs. So this could include in-home care, a nanny, after-school care, and obviously daycare. So if you have dependents, taking advantage of the Dependent Care FSA is a very strong planning tool. And again, with an estimated 30% tax savings, just passing through the FSA. All you do clerically is take some of your paycheck, pass it through the FSA, and reimburse yourself. You will save $1,500 a year in taxes, assuming a 30% effective tax between federal and state. So this is a non-trivial amount of money to have reimbursed to you tax-free for dependent care costs. All right, moving on to life and accidental death and dismemberment. As we noted in the What's New in 2025, you automatically have coverage equal to 2 times your basic earnings up to $250,000. Gundersen will be paying for not just the federally deductible $50,000 of insurance, but a full $250,000 of life insurance cost-free to you in 2025. So this is a large benefit that will be to you, and make sure that you name your beneficiaries properly on these benefits. Next, you will have the option to either purchase additional life insurance or additional accidental death and dismemberment. Typically, as a financial planner, I do not recommend accidental death and dismemberment unless you have a very high debt to income ratio or very high debt to asset ratio, so a negative net worth, and you struggle or would struggle to receive traditional life insurance coverage. And so if you're eligible for traditional life insurance, it is likely to your benefit to get that outside of these program offerings. So an individual term life insurance policy would be probably more cost effective and more comprehensive in death than accidental death and dismemberment. Additionally, group life insurance costs should be compared to an individual policy, but the only time an AD&D policy is to your benefit is if you have enough pre-existing health issues that you are either ineligible or it is very expensive to cover you with a traditional term life insurance policy purchased outside of your employer. All right, moving on to disability insurance coverage. This change is sweeping. It's healthcare system wide. Of the disability benefits, 60% of your income will be covered up to $2,500 per week while you're on short-term disability. The short-term disability policy will be offered as a benefit up to 12 weeks after a 7 consecutive day elimination period, and you will receive 60% of your basic annual earnings up to that $2,500 a week after your first 7 days of disability, which is again called the elimination period. So the benefit here is very meaningful, and so especially for expecting mothers or anyone going through a major health event in 2025, you will have a short-term disability policy paid for you by Gundersen to cover that 60% of income replacement up to $2,500 per week, which is approximately $10,000 per month in benefit to you after that 7-day elimination period. Of note here, because Gundersen is paying for the coverage, you will have that benefit taxable to you. So it's not a full tax-free 60% benefit. And so you will have to pay taxes on that as if it were ordinary income. Moving on to long-term disability, I do have a specific note here that there is both an employee paid option and an employer paid option. So the employer paid long-term disability will be offered to all employees who are eligible for the benefit at 0.5 FTE or more, including clinicians, associates, professional staff, and executive staff. And so that long-term disability coverage will be offered to these specific employees as an employer paid benefit. However, Gundersen does offer the option for you to pay taxes on the premium so that you could receive the benefit tax-free. And for anyone who makes more than $120,000 a year who will be maxing out this benefit, I strongly encourage them to go ahead and pay the taxes on the premium, because if you ever receive a long-term disability payout benefit, that means your benefit will be received tax-free, and it only takes about 2 to 2.5 months of long-term disability claims to make up taxes paid on an entire career's worth of premium taxes paid. So the typical long-term disability event is 3 years. So the average long-term disability event is 3 years. That means after you've met that 90 consecutive day elimination period, when your short-term disability drops off, you will be eligible for long-term disability. So if at any point you're in an event where you miss work for more than 3 months, your long-term disability benefit will pay you up to that $10,000 of coverage at 60% replacement, so $6,000 benefit to you. The main reason that I want to make sure that we cover this employer-provided long-term disability coverage is Gundersen offers the option to either pay taxes on this benefit or not. For almost all of my clients who are making more than $120,000 a year, there is a strong mathematical advantage to paying the taxes on the premiums so that you receive that 60% salary replacement up to $6,000 per month, tax-free, in the event you have a long-term disability situation. What that means is if you claim this benefit for 2.5 months, so you have a long-term disability event that lasts approximately 6 months, you will recoup all the taxes that you've paid on this long-term disability premium, and that is a benefit to you. So if you ever utilize this benefit, it is almost guaranteed that you will recoup any of the costs that you paid on that taxation of the premiums. So go ahead and elect in open enrollment that long-term disability radio button. Now that's for the employer paid benefit for clinicians, associates, professional staff, and executives. There's also an employee paid long-term disability policy. And once again, I would go ahead and recommend that you actually pay for this benefit, because long-term disability is the one thing that as a financial planner, if you do not have it, it can completely derail a financial plan. In addition to the long-term disability benefit offered through Gundersen, it is very important for younger accumulators, younger physicians, especially with a high debt to income ratio or a high debt to asset ratio, that you have not only an employer paid or employee paid long-term disability policy through your employer, but also an individual long-term disability policy through an outside carrier, such as Emeritus or Lincoln Financial. Finally, we have a lot of these employee choice benefits like accident insurance. I do not typically recommend any of these policies get taken out. This is basically an Aflac policy. There's not really much of a cost benefit analysis on this one that is to the benefit of carrying this coverage. The only thing I would point out is in the past, it did have a hospital admittance portion. And so if you're expecting delivery in 2025, it may be to your benefit to elect this employee only coverage and collect that reimbursement for admission to the hospital, which could be as much as $2,000. So essentially, if you elect the high for $8, you could pay $100 over the course of 2025 and then receive a $2,000 benefit for admission to the hospital. So it may be worth carrying this for expecting mothers, but that would be the only highlight here. Moving on, I would not recommend any critical illness insurance. Again, if you have the employer or employee paid long-term disability through your work and a personally owned disability policy, it is likely to your benefit to only carry those two coverages and not pay for the cost of critical illness insurance. I would not recommend carrying this to virtually any of my clients. And same thing with hospital insurance. It's high expense for a relatively low benefit unless you're an expecting mother. So that's actually why they've got this picture here. Again, you could pay an additional $300 a year or thereabouts for the high plan, and then receive a $2,000 benefit if you're admitted for at least 3 days for the year. Typically don't recommend identity theft unless you have a specific situation that you'd like to monitor. And legal insurance. I've not heard anyone have a good experience with this legal insurance. If you do need legal representation, odds are you're better off going to a private lawyer or working with someone in the local area to get that coverage. In addition, it might be a cost benefit analysis for those with larger pets, but for the domestic pets, the dogs, cats, etc., having pet insurance is typically not advantageous. It's better to not pay those premiums, save them over the course of a year or two, and then self-insure for any major pet expenses. Now, if you have a geriatric pet with a known health issue for 2025, again, run the premium versus expenses and coverage cost benefit analysis, and it could be beneficial for someone in a very specific situation, but generally that's not the case. Finally, and most importantly, the 401k retirement plan. So here's how we generally recommend saving to your 401k retirement plan. First, make the 5% contribution to receive the 4% match. Then look into funding the HSAs and potentially 529 plans, and then come back to maxing out the 401k for the year. So for those of you that are looking to make the maximum contribution to the 401k retirement plan, do not forego backdoor Roth contributions, HSA contributions, or any other tax advantage savings plan before maxing out the 401k. But do not miss out on the employer match either. So the matching contributions are maxed out at 5% to get the 4% match. For a lot of employees, they either do a 6% match to get 4%, so it's a net 10%, or you have to be strategic with contributions to make sure that you're not overfunding the 401k. And so if you have a higher salary and max out that 401k in September, you're going to miss out on the 401k employer match in October and November and December. So again, we want to have a very specific to the 10th decimal place contribution amount that we actually put into One America that's calculated based on your current pay and anticipated pay increase that comes mid-year. So those 401k contributions for higher salary earners should be a very specific calculation to make sure that we're not overfunding the 401k earlier in the year. For many of the middle range employees, for many of the mid-range incomes, I do want to recommend here that at least make the 5% contribution to get the 4% match, and then run an individual case analysis to make sure that you're putting the right amount into your 401k. As far as managing and investing your 401k, everything is still serviced through oaretirement.com. Go ahead and log in there. And we typically want to make sure that those 401ks are optimized for growth. And so knowing that Gundersen has a relatively limited retirement plan option, it may be beneficial to log in with your financial planner to make sure that that 401k is optimized. So there you have it, the 2025 Gundersen Benefits video for open enrollment in 2024. Again, there is a link below that includes both my email address and my financial planning and coaching websites. You're welcome to check out all three and schedule that complimentary 15-minute call to review your benefits. If you have any specific questions for me, please don't hesitate to reach out. I'm more than happy to help. We are in these benefits annually for our clients and want to make sure that you don't miss out on, again, a wonderful benefits package that is offered to you by Gundersen, your employer. Please take care. And if you have any questions, feel free to reach out to me in the email address below.